Hello, welcome everybody. Thank you for listening. Today we are going to be talking about financing new unit growth, smarter funding for franchisees. Talking about this exciting topic, you've got me. I'm Samantha Holt, Director of Sales at ApplePie Capital. I've been here for about 8 years now, since 2017. Joining me is Travis Perrine. He's our Director of Business Development. Travis is going to go through our agenda, tell you a little bit about ApplePie Capital so you understand who we are and why we're talking about this. And then we'll delve into sort of the ins and outs of new unit financing. Travis, if you want to cover our agenda, take it
Yeah,
away.
yeah, thanks, Sam. As a starting point, we're just going to introduce ourselves. Who's Apple Pie? What makes us different? We'll dive into some new unit financing and the Apple Pie core loan product and program that we have. Sam will discuss some of that for us, then flip it back to me to talk about growth up to 5 units and how Recap and Grow, which is one of our proprietary products, could jump in and be useful with that. And then we'll wrap up a little bit with some why now? Why some timing to jump into the waters? Why it's a good time despite some uncertainty in the marketplace. All right, so who is Apple Pie? Apple Pie, we are a 100% franchise focused financer. So we've made our world in the franchise space. We feel like franchising is a great ecosystem, and a risk mitigant in itself. So we built our business around that. We are in business now for a little over 10 years. We've secured over $3 billion in financing across over 200 brands. So we have a broad appeal across all different franchise industries. We do not believe that lending is a one-size-fits-all proposition. So we've built a number of service product lines for our franchise brands and franchisees that we work with, including our proprietary core lending programs, our conventional lending programs, and then some indirect or external partners that we have on the SBA and equipment financing, where we have a curated network of vendors that we work with and can connect your franchisees to. Um, what makes Apple Pie a little bit unique is that we take a brand first approach. We're not interested in lending to just any franchisor and their franchisees. We take an approach where we want to look for best in class brands that have really strong track records in both unit continuity and unit level economics. So, said differently, we look for brands that have a really nice history of getting units open and keeping them open and have compelling four-wall economics. Again, we're 100% franchise focused. Our entire team, from the relationship managers who work with the franchisees, the underwriters who review the loans, and the closers who help wrap things up for funding, are all industry franchise experts with decades of experience across the teams. And the relationship managers and the rest of the team spend time getting to know every brand that we have established relationships, so we understand the nuances and the ins and outs and the individual needs of each franchise system as we start to work with them. We are a consultative company, so the relationship managers are going to take the time to get to know your franchisees, um, and work with them not on just a transactional basis, but really look at what are their unique goals and needs, short term, medium term, and long term, and then help tailor a financing program that'll help them navigate that development schedule and ultimately reach their goals. And then again, the Recap and Grow product, which we'll get into more detail later, is a unique option that we have available that allows franchisees to accelerate growth by tapping into the embedded equity they have in their existing profitable units. All right,
Thanks,
that's it. Go ahead.
Travis. Gave us the Cliff's Notes version of Apple Pie. So obviously we cover multiple financing needs. Today, we're going to talk primarily about new units, but these are some of the other uses of funds that we can help with. Obviously, we can also look at acquisitions. This is true for new franchisees coming into the system too. If you don't have existing units, we can look at new unit financing or acquisitions for you if you're wanting to purchase a location that's already open. We are able to do multi-unit rollouts, If you're in a situation where you have more than one location to open at a time, obviously, that looks a little different with first-time franchisees versus existing franchisees. That's where we get into recapitalizations and things like that, which again we'll talk about a little later. But we can look at opening more than one unit at once, as long as everything makes sense. So that's something that is pretty unique to ApplePie and to conventional financing for first-time franchisees. So that's important to think about. Um, Obviously, refinances, we can do just a straight refinance for either lowering your interest rate, lowering your monthly payment. A lot of franchisees come to us to refinance SBA debt, to get a fixed rate, again, fresh term, release personal collateral. If your primary residence or additional properties are pledged in your SBA loan, we can definitely help with that. And then we also have some equipment in remodel financing available. We have a specific program for those types of loans. Generally speaking, those are 150,000 or less on the equipment side or on the remodel side, but we can definitely go up to 350, 400,000 on those. And it's just a quicker, easier process. So that's a good fit, not for a brand new franchisee, but as long as you've got one unit open, you can look into that type of financing for more of the one-off financing needs that come up. Uh, some of the bullet points as far as the loan and how it's structured, we do not require personal collateral or cross collateralization. What that means, it doesn't mean there's not a personal guarantee. We will require that, but we're not going to place liens on your home or any of your other businesses. That's not something as a practice that we do. It would not be required for any of our core loans. We've got fixed rates. They are competitive based on your credit profile, based on the use of funds. We've got our rates are a little bit lower for cash flow transactions, for example, right? If you're purchasing a unit or refinancing, that's going to be a little bit lower than new unit financing. But in any scenario, they are competitive and a lot of times lower than our SBA partners, which is nice. Franchise-friendly underwriting criteria, that's sort of what Travis was talking about earlier on. We know your brand, we're familiar with the franchise business model. It's literally all we do. So you're not going to have to do a lot of explaining on how things work. We're familiar with the ins and outs and the culture of your brand, and we make sure to set up the loan in a way that makes sense financially for you and where the loan is, you're going to feel comfortable that we're putting you in a spot that that's attainable. And for a business that's not open yet, you're going to kind of know what to expect and we'll help you get there. We'll go up to 10 years on our amortization. We can go down to 7, but generally speaking, for new units, we end up at that 10-year range. But 5 to 10-year amortizations, 10 years is pretty typical when we're talking about new units. The way that we distribute our funds is a little bit unique also. We do a lump sum distribution, which means that when the loan funds, you're going to get those funds directly into your business bank account. You're going to manage the project as needed based on your own timeline. There's not oversight there as far as the progress of construction, things like that. Obviously, we want to know about that and we'll be cognizant of that when we're funding the loan, but we are not going to disperse funds directly to vendors or anything like that. And it doesn't act like a line of credit distribution similar to SBA financing, which we can talk about a little bit later on. So lump sum distribution, which is nice, gives you that flexibility to sort of manage your project and time things out as you see fit. So there, like we just talked about, the few ways that, or the few products that we can use, there's obviously a lot of ways you can go about financing unit number one. Um, what a lender will be looking at in this for unit number one is your personal balance sheet and the brand that you chose primarily. Those are the two main factors that a lender is looking at in this case. Depending on how those two things look, you may have any number of these options. So let's talk about option number one, cash, yours or someone else's, whether it's a family member, if you're lucky enough to have someone in your life that wants to give you money to open a business, then you'd fall into this bucket. Um, Using personal funds can feel safer and sometimes less intimidating than getting a loan, especially for first-time franchisees. But there are real risks that you should consider if you're contemplating paying cash. And the biggest pitfall here is loss of liquidity and growth potential. Once you seek your cash into the business, it's tied up. You lose your short-term ability to access that liquidity if you run into unexpected costs, slower sales, personal emergency. There's any number of things that could happen. So this becomes more important if you're considering opening more than one unit, obviously, because once you have your first unit open, now the banks are going to be looking at three things: your personal balance sheet, your brand, and the performance of your first unit. So, for example, if your first unit has only been open 6 months or a year, let's say you're breaking even, which is pretty normal, and you're low on cash because you self-funded that first one, this puts you in a position where now you don't have enough liquidity for the down payment on unit number two. It's too early to leverage your first unit or take cash out of that unit. So you're pretty much stuck at that moment. So that's one of the things that you want to avoid. Um, the other important thing is, depending on how much cash you have relative to the project cost, if you have cost overruns, there's no bank to increase your loan amount there. And if you don't have the cash to cover it, you're now in construction and running out of money. And that's sort of the hardest spot in the process to get money. That's where people really get stuck. No one's really willing to give you a loan during that period of time. So this is obviously less important if you have significant liquidity or a smaller project cost, but still a lot to consider when you're thinking about self-funding. A better strategy tends to be to use the bank's money on unit number one and then leave yourself in a better position to either get another loan on unit number two, or if you really need to jump on a location and can't get financing for that subsequent unit, then you've got the cash as a backup option. So put differently, just save your cash for when the banks won't lend to you is sort of our motto. Um, Talking a little bit about SBA loans, ApplePie has a network of partner banks who specialize in SBA loans, and they are specific to franchise, so they're franchise lenders. And there's a lot of benefits to SBA lending. There's typically a lower down payment. Depending on the loan amount, you might see slightly lower fees, and a little bit more flexibility when it comes to the brand. So if you've got an emerging brand, for example, that's just starting to grow, SBA is definitely more open to those concepts. So it can be a very good option for those types of brands. Some of the challenges with SBA are they lie within the process. So things can move a little slower. There's more stringent requirements and paperwork due to the fact that it's a government loan. No surprise there. So SBA isn't a great fit if you're pressed for time, but one thing ApplePie helps with a lot is the navigation of that process. So we've been through it before thousands of times, and we help guide you on what to expect, what to do, what not to do. We act as sort of a liaison between the broker bank, our partner banks, and you. So we kind of help bridge that gap and help cut through all of the finance speak and help you understand what you're getting into. Speaking about our ApplePie core loan specifically, I'm going to go into more detail on the next slide, so I'm going to temporarily skip over that one. But then I'll talk quickly about the bottom two, 401k rollover. This can be a really good option if you've got retirement funds specifically from a past employer. You can leverage those and use them to invest in your business. I won't speak to the details of it. I would leave that to the experts, but we do have a handful of partners that specialize in that we've worked with for a very long time, and they do a great job. So if that's something that would pertain to you, we could help get you in touch with our partner rollover companies, and you can combine that with an SBA or a core loan, or if you had the funds in your 401k to finance the whole project, you could do that as well. Security line of credit isn't, I don't see that used too much, but it's definitely an option, sort of another form of self-financing. But it can be beneficial if a lot of your liquidity is tied up in the stock market and you can sort of leverage that without selling your investments. So obviously pros and cons to that. You've got to consider the market and things like that, but it can be a good option depending on your specific situation. So let's talk about ApplePie Core Loan and how that works with new units specifically. So we will finance up to 85% of the total project cost. And so what that means is everything in item seven. So all the things from everything from the franchise fee down to working capital. So that's going to make up the total project cost number. We're going to give you up to 85% of that. Um, the inverse of that is 15 to 20% down. So 80% financing or 75% financing, you're gonna come in with 15 to 20% of that number. We can obviously go higher, but those are our minimum down payment requirements. Um, Liquidity wise, we're obviously going to want to see that you've got the funds for the down payment. And then as a minimum, we want to see that you've got 6 months of fixed expenses left over. That's what that post-closing liquidity means. So we're going to take your rent, your estimated loan payment, and sort of the other fixed expenses that are a little bit more minimal, but the main ones are rent and loan payment. We're going to take that, multiply it by 6, and that's the minimum number that we're going to want to see as far as the total liquidity that you're bringing to the table. And this is within the borrowing group, so between all of the partners involved. It's obviously projection-based lending, so we are, your unit's not open yet. We are going to use what you know about your specific location and what we know about the brand to get to the projections, what we expect how we expect the unit to perform, and we're going to lend based on that. So we do our best to make sure that the loan fits within those numbers and we're not over financing or under financing you. One important thing to know is there's no building permit required to close the ApplePie Core Loan. When we speak about some of the SBA requirements and paperwork there, it's just a little bit more stringent as far as timing, when you can close, how the funds are dispersed, things like that. So we've give you some flexibility there, but we do require at minimum that you've got a signed lease and a construction bid before closing the loan. We want to make sure that you've had somebody look at your space, and you've got a pretty close idea of how much things are going to cost. That's for your protection and for ours. So the permit is one of those optional things. If if that's something that you want to obtain before closing, of course, that's a safe way to do it. But it's just worth noting that there's flexibility there, depending on your situation. Acquisitions, those are also something that we can do that we talked about earlier. So this would be purchasing an existing unit. This is available for both, like we said, new operators and someone who's got several units in the system. We can do it for either or. Same thing as the new unit. We can go as low as 15% down here. Um, the cash flow rates, like we spoke about, those are generally about 1 to 2 points below SBA. So SBA rates are typically tied to the Wall Street Prime, and there's a spread added to that index. So our rates, whatever that number is, given the market, ours are usually about 1 to 2 points below that, which is nice. And again, they're fixed for the life of the loan. Um, for units that are not currently cash flowing, so let's say you're wanting to purchase an existing unit that's not doing so well, but you're an existing franchisee, you kind of know the system well, and you have either a history of turning things around or your existing unit or units are performing well. We can use the Recap and Grow product to purchase things like that. So it's beneficial for people who are comfortable purchasing units that are struggling a little bit and turning them around. That can be a really good investment, and we've got ways to do that when it makes sense for both parties. So we talked about a lot for the ApplePie Core program and just new unit financing in general. But generally speaking, the core loan was designed for the main purpose of accelerating growth, regardless of how you do it. We wanted to find a way for people to grow a little bit faster, and have a little bit more flexibility there versus having to spread things out every 1 to 2 years and slowing that down. So this is just a summary of the terms that we spoke about. We didn't talk much about interest only. that is something to mention on new units. Depending on your brand, we will do an interest only period of anywhere from 6 to 12 months, which is nice. So while you're ramping up, while you're building things out, you've got that lower payment and just that IO payment for that period of time. Recap and grow. We keep saying this term, but we haven't told you anything about it yet. Travis is going to do a good job of talking about that. And then also sort of the pitfalls and strategies related to getting from units 0 to 5 and how to get there. So I will let him speak to that.
Thanks, Sam. Yeah, so for those who have designs to grow and to grow beyond, one or two locations, there's some things that you should be thinking through and be mindful of, some pitfalls and challenges that you could encounter. So, looking at this list, poor financial reporting. This is a common thing we see in lending. People oftentimes are really good at running a business, but they not may not be good at the numbers piece of it. Like they know how to take care of customers, how to provide a great service and a product, but the back end books may not be their expertise or their strong suit. But it's important when it comes to lending. It's also important just from an operational standpoint to be familiar with your numbers and be able to demonstrate to someone else what they mean. Because when you go in for financing, we're going to want to see P&Ls, tax returns, balance sheets. Every lender is going to want to look at those. To Sam's point earlier, when you're looking to expand or, beyond your first location, one of the big components of that review is your existing unit or units and how they're performing. So it's real important for you to have a good handle, for a franchisee to have a good handle on what those numbers mean, how they compare to the KPIs for the brand, for instance, and just how to interpret them. If you're running, unorthodox expenses through there, being able to explain why and how that all fits through there. If there's one-off occurrences that aren't reoccurring, being able to identify, isolate, and explain those as well. But understanding your numbers, having clean books that you can provide quickly is going to accelerate that review process as well. Because if it takes you, several weeks to a month to get a copy of your P&Ls from a bookkeeper and accountant, that's going to put a standstill on any lending process. A very important part of your growth. Having a scalable team, I think this is an underappreciated but extremely important piece. It's a very different skill set and a very different role in the organization from being a single unit operator to operating 2, 3, and 4, 5 units and beyond. You think about your first location, you can be an owner operator. You can be pretty much everywhere at all times if you truly want to. You have the ability to be 100% invested in that business, in that specific location and its operations. But the reality is you can't be everywhere at once. So as you grow, you need to be able to delegate those responsibilities, and you have to be able to cultivate the right bench within your organization to take on those roles as you grow, because eventually you're going to layer in some management like area manager or district manager. Your role shifts more to like a CEO role from an owner operator, and it's just a different skill set. So, you know, having that infrastructure in place and making sure that you have the right bench in place is incredibly important when you're looking to grow, because you need to have that in place to be able to grow into it. It's not a thing that you're probably going to have to do as much detailing from a lending perspective. Sure, a lot of lenders are going to want to see a business plan, and you need to be able to demonstrate that there. I think where it's probably going to be more scrutinized with lending is if you're perceived to be growing too quickly. Maybe you've got a strong performing single location, and then you get a great opportunity to buy 3 stores all at once. So you're going to go from 1 to 4. That's something that you're going to have to be able to demonstrate a pretty solid plan of action to be able to execute on that. Not only to the lenders, but to yourself as well. It's an important piece. Right sizing debt levels for growth. This is just about leverage. So you'll hear lenders say the terms under or over leveraged. And really what that means is if somebody's under leveraged, they likely haven't taken enough debt for the size of their organization and their growth objectives, more importantly. So this really goes back to what Sam was talking about when she talked about financing with cash. And it's really the balance between taking out debt and deploying liquidity. And as you're growing, and especially the acceleration of that growth, that liquidity or that cash on hand becomes more important, to Sam's point earlier. Once you invested it in the business, it's invested in the business. It's locked. It's locked until you can turn it into equity, which really takes profitability, which we all know takes time. So making sure that you're not under levering if you have accelerated growth objectives, because you want to make sure you have cash on hand to meet those. And then a number of other things that could be needed. There could be emergency equipment purchases, personal issues that pop up, all sorts of things. Over leveraging, and the inverse of that, or the flip side of that, is really just taking on too much debt. So that could be a factor of not injecting enough into your loans and ending up with larger balances per location or per unit. That, of course, would come with a higher monthly payment. So that impacts you in a few ways. From a lending perspective, we look at ratios, specifically one called debt service coverage ratio, which is just a measurement of the annual profit or cash flow of a unit and how that relates to the annual servicing of debt or their annual loan payments. So if you have greater than one in that ratio, it means you make more money than you make more profit than you have to pay in debt. If you're under that number, it means your debt is exceeding your profits. So you're going to have a cash deficiency on a month-over-month basis. So the larger your loans are, the larger your monthly payments will be, which affects that ratio. And lenders are going to scrutinize that when they're going to determine, are you ready to expand? Additionally, that means you're retaining less cash in the business, which gives you less dry powder, less runway to withstand any of those unforeseen circumstances or emergency needs that could pop up. And additionally, puts you in a weaker position for the liquidity side of what's needed when you're trying to obtain financing. Growing too quickly, I think this is really all the things before can really fall into this bucket. If you're growing too quickly, you may not have the time to right size the operations from a staffing and your team's perspective. You may end up with over leveraged situations because you've got a lot of debt stacked and your businesses haven't caught up from a profitability standpoint. So that's going to eat into your cash reserves. So there could be, economic and operational issues with trying to grow too quickly. So you got to be mindful of that. And then selecting the proper financing source, specifically loan terms and amortizations. That short-term, 5-year note might be attractive because it has an interest rate that's lower than a longer-term loan. However, it's generally going to have a higher monthly payment. So again, that's going to affect, what kind of cash you're retaining in the business, and also, again, those ratios that lenders like us look at, debt service coverage ratio specific. So, as a takeaway, a lot of people, if you're in growth mode, this is intimately important, but a lot of people don't like to show their profits. Their accountant's their best friend. They're shielding a lot of those profits in very creative ways. Word of the wise, don't do that while you're growing. Show your profits. It's going to lead to a lot easier time getting bank financing on board, and it's also going to make the financing more attractive. You can avoid having to go to usury type lenders like merchant cash advance lenders, or bootstrapping a bunch of personal loans because you can't qualify for traditional financing. And at the end of the day, those types of things can be a lot more costly than the taxes you were going to pay in the beginning. All right, so next up, when can I grow? So this is basically a demonstration of when is the right time to grow and how to finance. How does financing look at that? So SBA is a starting point. They're going to be a little more conservative in this respect. Most SBA lenders are going to want to see at least 12 months of positive cash flow or profitability. And going back to that debt service coverage ratio formula, they'd like to see your 12-month run at 125 or greater. So if you have $125,000 in profit over that prior 12 months, and you've got 100,000 in annual loan payments against the location, that's 125. That's a pretty standard ratio for most lenders in the community. A lot of lenders in the SBA world will even want to see 2 tax returns. They're going to want to see some of the profits on a recent tax return, not just your internal P&Ls. So you want to be mindful of that as well. So a little bit more conservative there. Not that being said, there are some SBA lenders that might be a little more aggressive than this. but I would say this is probably reflective of what's fairly standard in the marketplace. With ApplePie, one of the big advantages, again, to Sam's point earlier, we are built for speed and flexibility. And for a category one brand, which is our highest ranked brand and represents probably half of our relationships that we have with brands, will allow franchisees to go a lot faster than what the SBA does. In some cases, we'll even allow somebody to do two locations without the first one even being profitable yet. It really comes down to the specific cash flow cycles of the brand, the personal qualifications, the balance sheet of the individual owners and franchisees. But we're not going to automatically restrict that just by policy. We're going to take a look at it. If it makes sense, we're certainly not going to hold you back from doing that under the right circumstances. Again, or not again, soon we will go, I'll go into more detail on the recap and grow. But this is an excellent vehicle, and I'll demonstrate how the math works on it in a second. But it's an excellent vehicle for somebody to be able to accelerate their growth as well. Essentially, it's a way to access the embedded equity you have in the unit or location or combination of locations. And for membership-based businesses, so any subscription model, your fitness studios, your personal care business, anything that has a membership-based component to it, we'll even do a 6-month look back. So if somebody's only been open for 6 months and they were profitable from the day one, we'll look at the profitability of that 6 months, double it to annualize it, use that as the basis of the calculations we'll go through in a second. Which again just gives the ability to further accelerate and even get into some really attractive cash flow based lending options a lot faster than any other conventional lender in the marketplace. So the question here, refinance, recapitalize, or both. Recapitalization is really a cash out refinance. So it's really just combining the refinance piece with some additional cash out based on your equity. Reasons to do these, optimizing existing debt for better terms. We offer the ability to reset that 10-year term or amortization. As opposed to SBA lenders, we do not take your house or any personal real estate as collateral. We don't cross corporate guarantee requirements. SBA is going to do that. So if you have a business that you own on the side that's unrelated to the business that they lent to, but it has the same ownership structure as the business they're lending to, they're going to require you to guarantee the loan with that business. We do not require that, so that would go away as well. Fixed rate lending, so we're going to fix the rate, we're going to lower the rate as well, generally speaking, because again, to Sam's points, our cash flow lending rates are anywhere from 1 to 2 points below where the SBA sits. Some cases could be even a little bit more. And then another advantage could be consolidation of the debt. You may have been somebody who opened up multiple locations over a short period of time, and you took out individual loans for each one of the locations. So you have 5 loans with 5 monthly payments. You've gotten to a point where everything's stabilized now. The dust is settled, and you want to clean that up. So we could do what's called a global refinance, where we take a look at all of those together. We combine all the debt into one loan. And simplify things with one simple monthly payment, which just simplifies your books and the amount of time and attention you have to put on the loan as you go through your operations. So this is the illustration of the recap and grow we've talked about ad nauseum throughout this presentation. So the way this works is we will allow a franchisee to borrow up to 4.5 times their trailing 12-month EBITDA. For those not familiar with EBITDA, it's just essentially the operating income for the business, adding back some cashless expenses like depreciation, amortization, and interest. Whatever that number is, we'll give them the ability to borrow 4.5 times. So in this math right here, we have 200,000 in trailing 12-month EBITDA. 900,000 is the 4.5 multiple, so that's the borrowing base. In this scenario, they have a $400,000 loan. We can assume maybe that's an SBA loan. So the difference between the borrowing base and the debt is $500,000. That $500,000 represents the cash that we can provide back to the operating account for growth. Again, if it's a membership-based business, we can do a 6-month annualization. So maybe this business has only been open for 6 months, but they had 100,000 in profit over that 6-month period. The math would end up being the same. We'll double that 100 to 200, multiply by 4.5, and again, the math works out exactly like the chart shows. And again, the advantages here, giving them a very high multiple or valuation on their business of 4.5. We're going to put lien specific to the business that you're borrowing against, so the existing location. So if you're using that 500,000 to open up a second location, we're not going to forward lien or put any encumbrance on that business, which means when you have gotten that one to profitability and has the same track record, you can come back and borrow against it, and you don't have that $400,000 loan to refinance. Every dollar of profit or EBITDA is $4.50 of cash you can take back to your business for growth. Um, and then, variety of uses for these funds. You can put the funds towards opening up a new location. You can put them towards acquisitions, even underperforming locations. To Sam's point, if you identify a good target that you know is underperforming for various reasons that you can correct, you can use this product to purchase that. That's very hard to do in the market. There's not a lot of lenders that allow purchases of underperforming units. So we have a pretty nice solution there. And again, gives you the ability, along with the cash out, to refinance some of that variable high interest SBA debt that may have some personal assets attached as collateral. All right, so this part of the presentation, there's a video there that really does a nice job of explaining our recap and grow. If you follow that hyperlink to the Vimeo, it's about a minute and a half video, and I think it does a really nice job of just summarizing what we've just went through. So I welcome everybody to review that. And then lastly, this slide really is just I think has been relevant for the last 5 years of our lives. We've all experienced rapidly rising interest rates since the lows of the pandemic. Um, Inflation, right? Everything's gotten more expensive. We're seeing some stabilization there, but inflation's, we don't typically see deflation, right? Things are, even in a stable economy, things are generally going to get more expensive over time. So, these have led to a lot of folks being hesitant to jump in and grow and expand. And even though they may be very successful with their initial location or locations, and really just want to illustrate, things are not going to get cheaper, right? Real estate, construction costs, yes, you're never going to go back to the prices that were in 2020. That's just not reality. So, you need to face the reality that this is where we sit today. And the longer you wait, the more expensive things are going to continue to get. So better, if you've got the right operation in place, the right infrastructure in place, that should not be a reason to restrict yourself. Interest rates, if I knew exactly how quickly they're going to come down, I would be doing a different job for a lot more money than I am currently. I don't think anybody, if they tell you they know exactly what's going to happen over the next 12, 18 months, they're fooling you. But we do feel like they're going to start coming down, continue to come down, but it's just a lot slower than they went up. So that's just a reality. So if you're waiting for rates to come down, you're going to be waiting a long time. The importance of this is, what are you missing out of? What's the opportunity cost by being concerned about some of these things to the point where you're not willing to grow? There's a finite amount of real estate, right? Availability in your market that fits your business type. So you might get outpositioned on that real estate. And, if you're running a certain type of business and it has a really strong competitor, they could come in there and take that A++ location away, and you can't get it back at that point. So you got to be mindful of that. Time is money, right? Like, if you've got a good business model that's successful, the longer you sit on the sidelines, the more profitability you're waiting to obtain, and you're missing out on. So it's an important thing to think about there. So just wrapping up, we really appreciate the time that you spent with Sam and I. We'd love to present this to your system. We can tailor it for your specific brand. You've got our website there, Loans At. You can reach out to us there. We'd love to hear from any and all of you, and take this to your brand. Appreciate the time, guys.
Yeah, that was a lot of information, and just adding to what Travis said, Travis talks a lot, so this was perfect for him. It's a good avenue for him to share all that great information. But all of our relationship managers are just as knowledgeable, and scheduling a call with them, having the franchisees just speak with someone who knows their brand and who knows the ins and outs of this, they'll really help understand specific project, the needs of the individual and their future growth plans and how we can fit into that. So they're excellent at that, and this is all the ways that you can reach them. So thanks for listening. Hope everybody found it helpful.
You guys